The business owner sometimes would like to understand the profit in depth. They want to analyze how the measurement of profit or dynamics of profit is working for their companies. To understand that concept, we need to understand what is EBITDA, EBITDA, which is mentioned in the blue on the top of the left of the chart. What is EBITDA? EBITDA is earnings before interest, tax, depreciation, and amortization. Let me explain to you, break it down to you. Why do owners or CEOs or CFOs consider income in different form and shape? To understand this, let's understand what is EBITDA. EBITDA is earnings before interest, tax, and depreciation and amortization. What is earnings? The amount of profit produced in a particular period, right? What is interest? Interest earned on investments. If you have any investment, you have earned any interest. Taxes, this is an obligation to the government which we have to pay on our total profit which we have made. Depreciation is what? Wear and tear value, which we have discussed earlier. Wear and tear value of the tangible assets. And amortization, anything which is like spreading of the cost of intangible assets over its useful life. It's called amortization. So depreciation and amortization were in the same. Depreciation is applied when the asset is in physical form and shape. Amortization is applied when the asset is not in physical form and shape. For example, you have bought an expensive software for the company, then the depreciation of that software is considered as amortization. Software is not a physical item which you can see and touch, but it is still an asset. All right, folks. So sometimes a business owner or management level executives would like to understand EBIT, earnings before interest and tax. What is the reason why they would like to know what is EBIT? Because interest and tax are the elements which are not related to business as overall. For example, you have to pay tax to the government, and in order to pay tax, you will not incur or generate any sort of revenue. So there is no link between the business operation and tax. So the business owners would like to see what is my profit purely from my business before considering the tax on the profit and loss. Similarly, they wanted to eliminate the part of interest with the same concept that it is not directly linked to the business operations and understand what is earning before interest and tax. Further down the line, the business owner would like to eliminate any non-cash transactions which does not have a cash impact on the profit and loss account. You may be curious, like what are the expenses which do not have a cash impact? Those expenses are nothing but depreciation and amortization of the asset. So if you're calculating that your asset has got depreciation of, let's say, $100, you're not paying that $100 to anyone in the company or outside the company, right? We just recorded reducing the value of asset on the balance sheet and increasing the expense on the profit and loss. But this expenses, unlike other expenses, for example, fuel or internet, you're not paying to someone else. It is it is considered as non-cash item. So if we remove the non-cash item, then our profit is likely to increase further. This profit will show purely business operation form of profit rather than having a non-cash element associated to the profit and loss. That is the reason why the business owner would like to assess their P&L based on EBIT, EBITDA. All you have to do is when you have the net profit, remove the items which are linked to interest and taxes, you will arrive at EBIT. Similarly, if you remove the amortization and depreciation from your profit and loss account and calculate the profit, then you will arrive at EBITDA. Very simple concept, but very useful to understand the actual scenario of your profit rather than some elements which are impacting your profit but not directly linked to your business.